Chris Preston.
Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been delivering investment advice since 1970. Brad, we're in the dog days of summer. It doesn't feel like dog days on the market. I know we were talking earlier. Your kids went back to school like 3 weeks ago, so it doesn't probably might not even feel like summer to you, huh?
No, it's just like back to normal. I mean, like, I don't know. I think part of it is living in Arizona where like from July to September, you just don't go outside unless you're like transiting between two different inside environments. So it's not like the East Coast where you guys are like, oh, it's summer, the weather's nice, we're all gonna go outside. It's like, no, I go to my car and I drive to the gym and I go inside the gym. So I'm under like lockup right now.
Yeah, current temperature there is
I
right
don't know. I
now.
think it's probably like 90. It's eight
That's
o'clock in the morning, so it's probably like 90 degrees.
wow. Um, yeah, it's a very different world here in Vermont. My kids don't go back for another 10 days, I believe August 25th. In fact, they're just out on the other side of that door. They may make an appearance during this podcast. We'll see. We don't have a guest schedule, but we may have two of them by the end. Brad, tell people what we're going to talk about today.
So we are going to talk about inflation dipping back into the 2% range. How long will that or how quickly will that prompt the Fed to cut rates? We're going to talk about Starbucks poaching the CEO of Chipotle and whether a new CEO really matters. And we're going to talk about AST SpaceMobile, which is ASTS, that ran up 50% yesterday. It's given back a decent chunk of that today, but it's been on kind of a meteoric run. And then after that, we are going to talk about how important the last 10 minutes have become in trading. Um, Volume always matters, and institutions have always sort of liked the last hour and the first hour, but that's narrowed even further. But before we get into all that, Chris, you're up. It is your defend to take. Your take today, the American consumer is doing just fine, and it's only going to get better in the coming months. You have 90 seconds. You may begin.
Yeah, I mean, I know that probably sounds very pie in the sky, but yeah, this is sort of just to combat all the doom and gloom about the consumer sentiment or American consumer sentiment, retail sales, etc. Well, retail sales in July just came in higher than expected, up 2.7%, I believe. And consumer sentiment, as of reported this morning, up to 67.8, up from 66.4 in July, and higher than expected. Consumer sentiment is still well below. It's not 2018, 2019 out there. I didn't even realize this till I looked, but consumer sentiment has been lower since the pandemic, every single reading, than it was prior to the pandemic, for like 3 years. So, it's not pre-pandemic levels yet, but earnings growth was 10.8% this quarter, or at least through 95% of companies have reported, best since fourth quarter of 2021. Revenue growth 5.2%, above the 10-year average narrowly, 5.1%, best since fourth quarter of 2022. Consumer discretionary, so this is where sort of the retail and consumer sentiment part comes in, 5.1%, and that's revenue growth, and 11.9% earnings growth. Now staples are much more moderate, 1.9%, 1.5% EPS growth. But my point is, we keep hearing that the U.S. consumer is checked out, is done, and we keep getting readings that say otherwise.
Yeah, it's so much of this stuff is really hard because, like, anecdotally, people feel much differently than what I think the numbers play out. And it really, I think, comes down to where you sort of land on the spending spectrum. Like, even if you're affluent or high income, we had 10% inflation for probably close to a year, 6 to 10%, and now 3%. Like, your groceries cost more, your gas doesn't anymore, at least I don't believe. I think it's come back, it's sort of normalized. But like, life feels more expensive. So I think it's easy to lean into the everybody else must be struggling. I think that was a big narrative too, was everyone else is struggling and I'm doing fine. And
Yeah.
if that's all true, then everybody's probably pretty much doing fine. Obviously, there's going to be outliers, but uh, I don't know. I don't have like a grand lesson to learn from it.
Yeah. I mean, I guess it's just, put it in perspective. So consumer sentiment in June of 2022, it's a little over 2 years ago, when right as inflation was peaking above 9%, it was down to 50, the lowest reading in more than 20 years. And now it's up to, the high 60s. It actually got as high as nearly 80 earlier this year. It's fallen off a bit, but I failed to mention the reasons I think it's going to get better. We're going to talk about them. Inflation is down below 3% now, sort of in the Fed's magical 2% realm. And the Fed is almost certainly going to start cutting interest rates. So let's transition quickly to that.
Yeah, yeah. We had inflation come out this week. What CPI was 2.9%, I believe, in line with expectations. Earlier,
Best since March 2021.
yeah, and that
First
I
time
think
below
it's
3% since March 2021.
and I think it's in line with what the Fed has been expecting and sort of with their glide path, like we had talked about. Last week, there were lots of talk. There was a lot of talk about emergency Fed cuts being needed because of the Nikkei, and then everybody overreacted to the market movement. And it's like, all right, well, no, that plus jobs means everything's worse than expected. So we need an emergency Fed cut. Odds were like 50-50 that it was going to be a 50 basis point cut in September or a 25. That's normalized. Odds are now 75% that we're getting a 25 basis point cut in September, which I think feels right.
Yeah. When we sat here a week ago, I'm pretty sure it was over 50%. And I think you and I both said, not only do we not think that they'll cut 50 basis points in September, but I think the broad expectation will be that they'll only cut 25 basis points by then, and happen probably even quicker than we thought. I mean, it took a week.
Yeah, yeah. I mean, I think some part of it is probably just like the idea of an emergency rate cut got a lot of headlines, and that spun people out a little bit. I think people were probably overly sensitive to it because like a major index lost 12% in a day. That seems like a
Right.
black swan event. That seems like a catastrophe. So everybody's sort of primed for fear. I know Michael Brush of Cabot, cannabis investor who shares some market stats, had flagged that like the bull bear ratio had dipped down to like I think 2.5 on a 1 to 5 scale, where like a 2 is excessively bearish and a good buy opportunity, and it dipped down from like 3.4 to 2.5 in a little over a week. So I don't know. I think maybe we need to give investors more credit than a lot of people do. Like everybody knows that the market's highly valued. We've had a really good run up. So people are naturally sort of sensitive to anything that's going to challenge that narrative. But yeah, everything seems to be lining up. I don't know. I mean, that soft landing still possibly in the cards. I think JP Morgan says we've got a 40% chance of recession in the next 12 months, but they were saying the same thing 2 years ago. So
Hey, that's still less than 50%. So I guess they're sort of right.
like prognosticators are going to prognosticate, but
Yeah.
bears.
I mean, yeah, I mean, I think the Fed, we've talked about this. I think the Fed has done a good job. Is it an official soft landing yet? No, we might not know that. We probably won't know that till after the fact, right?
Yeah.
But we have gotten below 3% without a recession. So that's something to be applauded. And it seems like for all the panic, as fleeting as it may have been, all the panic about them not starting to cut rates at their last meeting in July, September almost feels like, the sweet spot, where we're just starting to see some yellow or red flags, namely in the jobs report. But as we saw from retail sales, consumer sentiment, that the consumer has not checked out yet. We've gotten some things right on this podcast, some things wrong, but I think one thing we've been pretty on about is what we think the Fed is going to do next. What do we think? How many cuts do you think this year? How many basis points? I'm going to go 2 starting next month. 25 basis points each.
Yeah, I agree. I think we get one cut in September. Like that's the one where it's going to spook the markets if they don't cut in September. In a
I'd be
way that I
shocked
don't.
if they don't.
Yeah, well, that's the thing is I think everybody would be pretty shocked if they don't. It's so heavily priced in, and they're sort of up against it, right? You only have 3 more meetings until the end of the year. So if there's any cuts coming this year, it pretty much has to start now. Uh, yeah, I think we get two. I think we get a cut in September and then maybe another one in December.
I agree.
The market,
November feels a little too close to the election.
yeah,
Yeah.
yeah, and they've shown that they're not in a hurry to cut them. They've been saying higher for longer for years. Um, I do think that the market is too sensitive to the headline element of it, right?
Yeah.
Like the Fed cutting 25 basis points or 50 basis points is going to have like a 18-month lag time before the effect of that it really trickles into the economy.
Yeah.
So I guess maybe it's just signaling what they'll be doing going forward more than anything. But
Right.
you'll probably see a lot of volatility. If they come out and cut 50 basis points, I would be very surprised in September. 25
Yeah.
feels right.
Right.
And
But even
then
just psychologically,
you know,
them starting to cut will be no, maybe by then it'll be all priced in. Probably will be. But just psychologically, that's why we've seen this rally since, or why the rally started last, November is when they finally indicated we plan to cut next year. Originally they indicated 3. That I don't think that's going to happen. 3 cuts, but you and I both think 2. Okay, let's go to the next topic. Another big news item this week was Starbucks is swapping out its current CEO for Chipotle's CEO, successful CEO, Brian Niccol. Brian Niccol oversaw Chipotle's turnaround from March 2018 till now. It's sort of, we wanted to talk about how much CEOs matter for like established companies. Of course they matter. Founders, CEOs, Elon Musk mattered, and we wouldn't have Tesla without Elon Musk. Steve Jobs,
yeah,
mattered in making Apple what it is today. But then, like, are CEOs of established companies, are they more like NBA coaches or Major League Baseball managers, don't screw it up kind of thing? I think generally that's the case. But I think in the case of turnarounds, I don't think Starbucks is really a turnaround. This seems more like a don't screw it up kind of a situation. But Brian Niccol's previous stop, Chipotle, when he came in, it was right after they'd got, taken a lot of flack, rightly, for poisoning customers with, what was it, bacteria, E. coli
yeah,
in their food. I think it's in lettuce a lot of time, in multiple locations over a span of weeks and months. So confidence had dropped and the share price really dropped. It was, at least on a split adjusted basis, is $6 a share when he took over in March 2018. Now it's 53.54 a share. Seems like he mattered there. And I know we have a service, Cabot turnaround letter, that has something called a catalyst report, and catalysts that could spark a turnaround. And often with these down and out companies, it's a new CEO coming on. So I think with turnarounds, CEOs matter.
yeah.
But 80% of the time, maybe not. Well, what's your take?
All right. So on the Chipotle thing specifically, here's why the new Chipotle or the new Starbucks CEO does not matter at all.
Yeah.
Why the best case scenario is they just don't screw it up.
Right.
Starbucks has a 55.23% market share. So like for their segment, they are more than half of sales. So companies like Dutch Brothers or Dunkin', like their coffee sales, right? Starbucks owns that market. Chipotle right now has a 16.7% market share. Their CEO can't was and could have been growth minded while he was with Chipotle because they were growing from a small slice of the sort of fast food market to a meaningful slice, right? 17% is good penetration. If you're a restaurant, that's one out of every $5 almost. Well, one out of every $6 that's spent in fast food is now spent at Chipotle. Starbucks is not in a position to benefit from Nichols' experience running a growth-oriented company. Like they already own half the market. They're not going to do what Chipotle did and start opening restaurants. And now we go back to the thing we saw in like the early 2000s where Starbucks was opening Starbucks across the street from another Starbucks, but now there's also a Starbucks in the Fry's or the Kroger or whatever grocery store is right next to you. I don't think Starbucks has the upside potential to grow in the way that Nichols' experience would lend itself to.
No,
I
no.
think they are very much in a don't screw it up situation. I mean, if you look at like Microsoft, they transitioned from Gates in like 2001, 2004, somewhere around there to Steve Ballmer for a decade. But Gates was still on as the CTO and he was still chairman of the board. And then they sort of gradually moved over to Satya Nadella. Um, Jobs and Cook at Apple was sort of a similar transition where it was a slow burn and it was over a number of years. And it even those companies, like during the handoff, especially from the Jobs to Cook, there was a lot of conversation about has Apple lost its fastball? Is it
Yeah,
still innovating?
right.
Um,
I've
you
written
know,
those words.
yeah, yeah,
Yeah.
exactly. And everybody did. That was the concern. So, but like that was a really carefully orchestrated CEO transition, and it turned out really well, and everybody was sort of suspect of it for years while it was taking place. This
And that's
one,
probably what Starbucks is hoping for.
well,
Well, they didn't. They're not coming off of Steve Jobs, so I guess it is a little different.
yeah,
But you know, it,
exactly.
like what Nichols trying to do now. This is why it's so similar. So if you take over the Yankees, don't screw it up. Here's I guess the better example. Mike Krzyzewski retiring at Duke. John Shire, don't screw it up.
Yeah,
It's not like you're going to take it to another level. Um, Jim Harbaugh just left Michigan after winning a title. Whoever I can't remember who the new guy is. Don't screw it up. That's kind of Nichols' position, and you earn that position often by doing something impressive at a previous stop, and he did at Chipotle. Like I said, share price from $6 to $53 during his tenure, and sort of restoring its image, like people trust, like they're not going to get sick by eating there, and expanding. That is, I think, what do you say, 16% market share? I don't know what they were when he started, but I bet it was less than that.
yeah,
Um,
probably like 10 or maybe even lower. But that
yeah,
I mean, what's
Yeah,
Starbucks going
Starbucks
to
is
do?
ever present. Some places, Starbucks is the Yankees. Starbucks is Duke basketball. It's Michigan football. You know, it's embedded in the fabric of you know American society, really the global society. It is. He doesn't matter here. He mattered at Chipotle. He doesn't matter here. I guess is my point.
Yeah, I will say, just in thinking about this, Starbucks has pinned a lot of their sort of growth hopes, I think, on China. I was reading an article from Carl Delfeld that he'd written about the coffee competition in China. He wrote for the Daily. I think they closed like 100 stores there. So maybe the new leadership can leverage some of that growth experience and continue building out internationally. But they don't really have room for domestic growth. What are they going to go? They're going to go from half of all the coffee sold here to 75%. Like
Yeah.
that's not realistic. Their opportunity for growth is probably like a sister company, some new iteration of Starbucks where it's like, um, yeah, like a drive-through only limited menu, like pop-up adjacent kind of thing, right? Like there's probably room for them to get some market share on the margins. They've got room to improve profitability, I assume, and maybe like stickiness with some consumers, but that growth opportunity just isn't there. So I don't. I don't see how this turns into a home run for them.
No, I mean it's a good headline, probably, and seems like a good CEO. But again, I don't. It's still more of a just don't screw it up situation. And as hires go, he seems like a guy that probably won't. So
Yeah.
maybe that do no harm in a do no harm kind of a way. Maybe this is a solid hire, even if it doesn't necessarily move the needle. What's the what is it, wins against replacement is the measurement in
Yeah.
baseball, like replacement level, like it's just some generic CEO, faceless CEO, him versus that person at this point in Starbucks lifespan. I don't know that he creates a lot more wins, but
Yeah, they
I
could
don't think
make
he'll be a negative,
they
wins
could
against.
make you or me the CEO and we would probably not screw it up too badly. Right?
Maybe.
They've got the like they've got the organizational infrastructure. They
Yeah.
know their consumers super well. The consumer loyalty program is excellent for data mining and for tracking consumer behaviors. They are probably experimenting with like personalized deals, which a lot of retailers are doing right now. Like everything they have everything they need in place to maximize the profitability of the company. They have the brand recognition. They're not going to start making like semiconductors or something like that, right? They just I don't know.
Yeah.
Looking at like Apple or Microsoft, like they didn't really run up share price wise in the intervening years until AI came on the table, and then we had the Mag 7. I mean, I guess with the Fang stuff we did, but I think best case scenario is probably like a jobs to cook.
Right.
Although Starbucks doesn't have the luxury of the long runway to get there.
Right.
Because
Yeah. I probably would screw up Starbucks because I don't drink coffee. So I'd change their entire menu to chai or something. Okay. So let's
black
go.
black
What's that?
coffee only, black coffee only, no more frappuccinos and like egg bites is all I would do, I
Yeah,
guess.
I think we'd be two opposite ends, opposite extremes that would probably screw. You need a coffee connoisseur, maybe. Okay. Number three in the big three, AST SpaceMobile. That is a company that was up, whose stock was up 50% yesterday. Why? Because so they are launching the first commercial satellite, or first commercial satellite launch is supposed to happen in the first half of September. Because it's at the satellites. There's supposed to be five of them actually.
Yes.
Are in Cape Canaveral now. I think that's part of what moved the needle with the stock price. Space-based broadband company, pretty innovative, potentially revolutionary company. You wrote about it a few months ago for our website. Tell people your thoughts on it.
So we wrote about it in June. It had run up from like $4 a share to $12 a share. To my great shame, I said put it on your watch list right then. Now, in my defense, I am not a paid advisory service. The daily, the daily isn't like, hey, go out and buy this and then get out of it at a certain time. It's more like, hey, this should be on your radar.
Yeah.
But
And you
what they're
mentioned it at $4 a share. It is now at
no, I
29,
mentioned it at $12 a share.
12 bucks a share.
It had come up from $4 a share.
Gotcha.
What they're doing, they're a space-based direct-to-device satellite
Yeah.
communications provider. So instead of having a satellite phone, your iPhone or Android phone or whatever is just going to get a signal from space. They are launching the first five of their Bluebird satellites in the first half of September. That's part of the reason for the run up yesterday. They reported earnings. They're pre-revenue because like they have one test satellite in orbit
Right.
right now, and that's it. So their pre-revenue earnings didn't matter, but everybody seemed to respond positively to the fact that their plan is on track to finally get these satellites launched on a SpaceX Dragon in the first half of September. They'll have a 7-day window that they'll announce as the date approaches, and it's going to be somewhat weather dependent, but the expectation is first half of September. Part of the reason they started running up earlier in the year is they're under contract with a lot of mobile providers. So AT&T, I believe maybe not, maybe Vodafone. I don't remember. AT&T was a big one. Um, and so they're under contract to provide satellite service in some capacity. The way that it was pitched by AST, at least in their early investor presentations, would be effectively the same as like international roaming, where what happens is you have the opportunity or you have the option to use their satellite-based mobile connectivity, and then you get like a day pass for it, or you pay for a month of it. So similar to if you're traveling overseas, the way international roaming still mostly works. Um, the sort of moonshot element is that their plan is to get more than 100 of these satellites in space. And what they do is it's a really big array. It's like 700 square foot. It's like the biggest low Earth satellite um, ever, I think, at
Yeah.
least
Yeah, it is.
at that altitude. So they're going to put up 5, and those are going to circle the globe, and they're going to give you cell service in like Kansas or in the middle of the ocean, wherever you don't have ground-based coverage. And their goal is to build up
Shots
to
at
over.
Kansas.
What's that?
Shots at Kansas. Sorry, go ahead.
Worst drive of my life was driving through Kansas. It's like flatter than a pancake, literally, if on the same scale. It's just wind pushing my U-Haul at like a 45-degree angle. I was getting 6 miles to the gallon.
Yeah.
But they don't have a
There go
lot
our
of
Kansas listeners. Okay.
but so they
Yeah.
don't have a lot of ground-based cell coverage in lots of America, right? So ASTS is gonna provide that, and ostensibly they could target the entire world. They have talked about moonshot opportunities in providing rural broadband satellite space speeds at in the global south, so like Africa and part, that kind of part of the world. The reason that I had a hold on it is that space is really hard.
Yeah.
Um, they're going to be launching in early September. If their satellites don't deploy, the way that their deals are structured with the cellular providers is that it's revenue sharing, right? It's all dependent upon their system working. If their satellites don't deploy, they're going to have to do another round of capital raising to hopefully build more. It's almost like an FDA approval for like a drug company coming up in early September for them. So it's a high risk, high reward. I think it really just got on a lot of people's radars after that earnings report, and
Yeah.
you know, bid up 50% in a day. It's an $8 billion company right now, so it's there's no valuation metric. They've talked about it being like $100 billion opportunity if they're if they're able to execute and get to the penetration that they think they can get to where it becomes ubiquitous, right? Like their best case scenario is that they deploy like SpaceX, where it's just part of the fabric of
Right.
technology now.
Yeah.
Um,
And by the way, the stock is in two different Cabot uh, advisory portfolios. I won't say which ones, but both. It was in early enough, similar to your timeline. You recommended it in June. In both cases, it's already doubled in both portfolios it's in. So, been on Cabot's radar. And people who got in even a couple of months ago have made a lot of money. Like you said, whether people will continue to make money on it will depend on, at least in the short term, on how this launch goes in a month.
yeah.
And if it goes, if it's delayed to like October, that wouldn't be good. But they keep saying September. So,
Yeah. Yeah, I'm not super worried about the actually deploying from Dragon. Dragon, I think, has like a 99% success rate. The
yeah,
risk is that when they start unfurling, that they're just not at sort of the quality level and consistency level where they can effectively deploy. I don't know if just one failing to deploy is the end of the world for them, because it that's an 80% success rate. But if
yeah,
like two or three, or if more than, or if all of them are having difficulty unfurling, then their entire business model is sort of in question at that point. In their earnings call, they mentioned that they had sort of scaled for vertical production, so they're ready to start building. But what they didn't really say is that they don't have the money to start building unless this first launch goes off successfully. So if you're
would
the
you
kind of
recommend it at these levels? $29 a share, up from two as recently as May.
I didn't recommend it at 12. I said, hey, add it to your watch list. I was too conservative for it then.
You're a
I
hold still.
I I don't know. I don't love the drug approval binary event stuff in general, and I'm I skew bearish and conservative with investing. So if it's the play money, I think you could probably get in closer to like 25 or even in the low 20s when we get closer to the launch date, when some of this initial reaction uh, bleeds out.
Yeah.
And then you can, maybe take a flyer position and just hope the launch goes well.
Yeah.
Um,
It'll lose some momentum. In fact, it already has, down 6-7% today. Not that that's to be unexpected whatsoever after a 50% up day. But
you could also take a stake in it if it, I mean, even at these levels, and then just buy some protective puts that go out through September. It's going to be expensive insurance because the volatility is high, um, but that's not an unreasonable way to handle a binary event.
yeah. Okay. Before we transition to our featured segment, just a bit of housekeeping. Wanted to plug Cabot Dividend Investor. That is a income-centric advisory run by our own Tom Hutchinson. The reason I'm plugging it now is Tom has fared very well recently. His average, so he has 20 positions in there, I believe. His average return is over varying time spans. Dividend investing, it's more of a playing the long game, as Tom does. But his average holding in there has a return of north of 80%. I think only one or two of his stocks are down, and those are down very small amounts. He and those are total returns. Those include the dividends. Has three different portfolios. There's like a dividend growth portfolio, and there's more of a safety portfolio. But that's Cabot Dividend Investor, run by Tom Hutchinson, and that is on the Cabot Wealth Network website under Premium Advisories. I highly recommend subscribing, especially given the volatility we've seen the last month or so. It's a good time to be a dividend investor, as we talked last week with our guest from Sure Dividend, Ben Reynolds. So a Cabot Dividend Investor, that's our recommendation for today. Also, as always, please like and subscribe us if you are watching on YouTube or listening on Apple Podcasts. We could always use more like and subscribes. That's what keeps us going. Okay, now featured segment for the day. Last 10 minutes of a trading day. They're a big deal, increasingly so these days. How big a deal, and tell us why exactly.
So Barron's came out with an article that referenced a study that found that 30% of the trading volume in a given day takes place in the last 10 minutes. I mean, that's a third of the entire trading day happening in 10 minutes.
Right.
Going back to, I don't know, the mid-aughts, right, or late aughts, the sort of the standard knowledge or the common knowledge amongst like brokers and industry people was like half the volume was in either the first half or the second half of the day, or not the first half, the first hour and the last hour of the day. That is because institutional traders can't do a ton of volume without risking moving the market. And the opening orders and then the market on close orders are the two places where there's a high enough volume that you can make meaningful moves if you're an institutional trader. Now, because of the rise of electronic trading and more sophistication there, it seems that has narrowed even further from that sort of rule of thumb, first and last hour, to like the first hour starting at like 7 a.m. is when institutions really come in, other than the overnight trade, which is your longer term, like your pension funds and stuff. Your hedge funds mostly are not trading until like 7 a.m. And then the last 10 minutes, part of that is due to the rise of options trading. The notional value on options is significantly higher than the underlying shares that are transacted on like any given day. So you get a lot of what's called delta hedging, where if I'm a market maker and I sell a whole bunch of calls that are expiring, say at the end of the week or on normal options expiration, I'm not super worried about the exercise of those calls until we get to the end of the day. That's the first time that the exercise is going to come in. So what I do is I sell a bunch of calls and I'm now in, say, a net short position. if whatever I'm selling calls on an index or an underlying stock or whatever, if that runs up a bunch, I start losing money. So I need to hedge that by going long shares. There's a lot of different ways to hedge, and everybody's going to have their own sort of is going to strike a balance somewhere. Some people go out and buy other options, some people buy stock, but the net result is that at the end of the day, you get a lot of transactions where market makers are balancing the risk on their portfolios by buying stock or selling stock. It's especially visible when you get to options expiration. The normal monthly and quarterly are the big ones, but to a lesser degree, weeklies. End of month, you get a lot of volume because you've got funds that are maybe balancing portfolios, and end of quarter is a big one. May 31st was a date where we saw like the S&P and the NASDAQ all move like 1% because there was a big imbalance. There was a ton of buying that was taking place at the end of the day because people were balancing their portfolios for the end of the month. But what it does for regular investors is it ups the volatility at the end of the day, and it adds a little what's the word I'm looking for? It sort of shrouds what's happening in the marketplace, because one thing that you see if you are a market maker is a level 3 quote book that comes from the exchanges. And those go out and they say X, Y, or Z hedge fund or pension fund or whatever, they're going to sell 200,000 or a million shares of a stock. We need somebody that's going to come in and provide liquidity. If we're as retail investors, not if, but as retail investors, we don't have access to that data. We
Right.
can't see it. There are services that like provide that to retail traders and stuff like that. But these are big moves that are telegraphed to market makers, but that are not visible to regular investors, to retail investors. So it seems totally unexpected. In most cases, the expectation is that the market maker is going to step in and provide that liquidity. In some cases, the market makers may be inclined to sort of directionally pile onto the trade. So if they see that UBS is buying a million shares of something, they might say, well, we're going to take a position too. And then you see those big like 1% intraday swings in like the last 10 minutes. They're rare, but there's not anything that you can really do as a retail investor to anticipate that or plan against it.
Yeah,
Um,
and because fortunately, because Cabot, we're an investing firm. We're not a trading, we don't have any day trading or even any pure trading advisories. I guess the closest thing, Cabot Top 10 Trader, Mike
yeah.
Santolo's Cabot 10 Trader, which is every week the 10 of the best momentum stocks. That'll Mike provides sort of buy ranges with each of those. So, I guess where it could impact that is, you say you get one of his recommendations and it's not in your buy range to start the day. You could, in the back of your mind, knowing that, things changed a lot, especially in the last 10 minutes of the trading day, you'd be like, maybe it'll dip to my buy range, by 3:55 p.m. Eastern, and I'll pounce then, that kind of thing. But even that's not just purely a trading service. If you're investing for the long haul, I don't think it matters a whole lot, outside of huge moves like we saw in AST SpaceMobile yesterday, where it did go up 50% in one day. If you missed out on that, yeah, you missed out. But those are, rare black swan or maybe white swan events. But it I don't know that it's something that the average investor needs to be too worried about. As you said, it affects options trading more, but even that, Jacob Mintz doesn't even do many weekly options, let alone, daily trades.
Yeah, so there are two things that I think are useful sort of takeaways. Limit orders, if you're looking to get into a position, like we talked about top 10, right? Like, hey, if it dips from here, we'll be looking to add a position. Using limit orders is a way to take advantage of some of the big swings that might otherwise be unexpected. So even if it looks like intraday, it's moving away from you, having some of those limit orders in place, saying, hey, if it dips down, I'll buy it. That's one way that you can I'll even say, I'll go so far as to say take advantage of the volatility,
Yeah.
because uh, other retail investors don't know what's coming either. It's only the institutions that are seeing what's actually moving this, and it's only on the books of the big traders where you can tell sort of what direction they're going to need to hedge. Um, the other thing is with options trading, right? Like the whole reason that so we had talked about, or the Daily had written about this a little bit a few months ago, specifically because it's a risk if you're a short-term option trader, because it what it ends up doing is it squeezes you out of the risk of your option being exercised, squeezes you out of the position. If you're an options buyer, if you own calls on something, um, most brokerage firms are going to make you close that out by a certain time. Normally, it's like 3 o'clock Eastern time. Sometimes it's 3:30. Like Robinhood automatically closes positions at 3:30. Other brokers, you can submit instructions not to exercise, and then you can trade right up till the close. But if you're trading short-term options, it is a risk that you should be aware of, that like you've got institutional risk management that might close your position out because it's at risk of being exercised, and they don't want that risk. So it does make a case against trading some of the ultra short-term stuff, daily options, weekly options. Jacob doesn't trade those, and he doesn't trade them for a reason. He looks at monthly options, longer term, even going out to leaps, so multi-year options sometimes. So the two things to sort of be aware of is it presents an outside risk if you're trading really short-term options, and because that volatility is going to be unexpected or can easily be unexpected, using limit orders if you're considering entering a position is sort of a good practice.
Yeah.
But it's unfortunately one of those just structural issues with the market where we're at the, you know, we're sort of at the beckon or at the we're moving at the behest of the institutions. When the big money's moving things, we're just along for the ride.
Right.
So yeah, it's crazy that the options market is getting to the point where it's the tail that's wagging the dog. Um, if you wanted to try and plan around it, you can start looking at something called gamma. It's the outstanding. It's a measure of how much the outstanding options contracts will force institutions to presumably hedge. But I mean, that's like getting deep into the option Greeks. For most retail investors, especially long-term investors, maybe just don't sweat that early and late volatility. Rely
Yeah.
on your long-term investing plan.
Yeah. No, I think that's the takeaway for sure. And for most people, since most people are just, long-term investors. I think that's a podcast. What do you think?
Yeah, I agree.
My kids did not make an appearance. I'm almost disappointed, but electronics are a powerful draw. But thanks for joining us for this week's episode of Street Check. We'll be back next Friday, hopefully with a guest, and we will see you then.